Hey traders, let's take a moment to thank and feature one of our top sponsors, FX2 Funding. If you're looking to get funded, listen up. FX2 is offering traders the chance to trade with up to $200,000 in simulated capital and receive up to 85% of their results. If you're interested in getting started, use the link being dropped in the chat or the link down in the description below. If you pass the evaluation, you'll receive your feedback and gain access to your new account. FX2 allows traders access to a wide range of assets and allows traders to hold their trades over the weekend. FX2 is giving A1 Trading Show fans 15% off the evaluation fee if you use promo code A1Trading15. So if you'd like to learn more, again, use the link being dropped in the chat or the link down in the description below and use code A1Trading15 at checkout for a discount on any of their evaluations. Now back to the show.
All right, traders and gentlemen, welcome back to another live stream. Thank you for being here. It is the big one. Today we have the FOMC event. This is going to be a two-pronged event. And to help me get through it, I did a stream earlier. I got my Coke Zero here today. And don't tell me it's not good for me because you know what? I don't smoke and drink that much. So come on. Little Coke Zero is not going to hurt anybody. Anyways, welcome back to stream. Thank you for being here. We've got a lot to get into. Today is probably one of the most important days so far this year. We have Jerome Powell speaking. We also have the federal funds rate decision, which is largely expected to be held at current levels at 5.25%. And we'll continue to watch that close as we get into the event. The question of the day, it's all about forward-looking guidance as to what is likely set to happen next with the federal funds rate. Are we going to cut rates in March? That is the question. That is straightforward. Simply put, what is going to dictate my outlook for the weeks ahead? This, as well as NFP, will be two of the most important events that we get so far. By the way, what do you guys think about that new stream thing? We got the kind of arcade style, and I feel like this is nostalgic for a lot of us. Maybe not all of us. Some of you guys may be a little young, but we played a lot of arcade games growing up, and we had a lot of fun putting together the stream theme here. We had all sorts of good stuff. Perfect. Love me some Coke Zero. Anyways, as we get started here, there's several markets that I want to discuss, and let me lay out a little bit of a game plan here for today. We have about 30 minutes here before we get the Fed funds rate. And we'll be joined by a couple different key guests on the show. Today, we'll have Frank coming back, who, of course, you guys know Frank. You know him. You love him. How could you not love Frank? He's an awesome guy. And he also is the other trader inside of our trade room and a long-term close friend of mine. So we are going to discuss things with Frank, but we're also going to have Chris Pulver on. And we'll get the Pulver report. That's what he calls his live show. I love that. The Pulver report. I feel like that's just such a cool name. But anyways, Chris Pulver, he is he's managed money for many clients over the years. He's a very professional trader, and I'm very excited to have his commentary to help us weather the storm. We've got a lineup of special guests coming on the show, and I'm really excited. Awesome new theme. Thank you very much. Okay, so let's get in. First of all, the indices continue to have some pressure on them, and I'd like to start by actually taking a look at let's get a pulse check on the whole market. Let's go to all markets here and we'll take a look. We got everything pulled up here. We've got everything from indices on the left here, the US dollar, some currency crosses, and gold and oil. Let's have a look. So summarized view, the S&P 500 as well as the NASDAQ have been under pressure recently with some tech earnings coming out. Google and Microsoft, a little bit disappointing. We discussed that earlier in today's earlier live stream. We've been live. This is our second time. The Dow coming down slightly, but really not feeling the burden that the other two are feeling. At the same time, the dollar index shot down this morning off of ADP. The private sector saw a large less than expected hiring when it comes to jobs. That showed some weakness in the US economy. And nothing sells off the dollar harder than weakness in the US economy, especially that labor market, which is so key to the whole picture. So we saw ADP numbers come out real cool this morning, and it caused the dollar to sell off. You know what else it did? It really ruined my oil trade. I stopped out on oil. I say it ruined. I mean, it was a small loss, but it was a loss nonetheless. That ADP number really acted to push things against me here on my oil position, but that's fine. I'm very, very sidelined here going into this event, and that's honestly how I'd prefer to be, with a fresh slate so that I can make a clear decision on everything. The euro shot up, the pound shot up, giving back some of those gains here as we approach the event. Same thing with gold, huge push to the upside. 2055 was quoted there, now pulling back to 2047. It's an interesting move here so far today, but again, you're really not getting the bulk of what I think the move will be until you start to hear from the man himself on representing what the Fed is thinking in terms of going forward. Are we going to see rate cuts? It's all about that March rate cut. Is it on or is it off? And what we hear from him is going to be hugely impactful. Let me tell you straightforward as we get started with this, my bias. And I've outlined this. If you're someone inside of our Discord channel, let me just be clear here. I outlined this inside of our Discord. I put out the full breakdown here. Feel free to read that if you prefer the written bullet point version. But essentially, I think that all the strong economic data out of the US could act to strengthen the case that they do not rate cut in March. Now, I'm in front of 600 plus people. I've said this in front of tens of thousands of people over the last few weeks. If I am wrong about this, I will acknowledge it very quickly. Okay. So if the Fed comes out, if Jerome Powell comes out and he actually says something to the contrary nature of this, which you'll notice, I have my if-thens all set up here. If the statement, we hear a likelihood, increased likelihood of a March rate cut, I will probably flip to being a dollar bear. Right. So if we've seen some of this inflation data that comes out pretty cool, and it has been a nice softening amount of data here for the inflation side. If that is the case, I will probably switch to a dollar bear, and you'll probably see that happen in front of you today if we do get a soft, or a dovish sounding Federal Reserve. If we get, however, a situation in which March rate cuts get pushed back, which is my base case. I think that we're going to push back rate cuts with all the strong economic data. If that happens, then most likely, I think the dollar stays real strong, and we could actually see a bit of a pump on the dollar to the upside, which would bring indices coming down harder. That's my bias going into today's report. With that said, let's go ahead and jump into some charts. Okay. So starting with the dollar, it's all about the dollar here today, guys. We're still range bound. And if we do, in fact, like I said, if we get acknowledgement from the Fed, here's what I think is going to happen. Okay. And I'm saying this because I'm saying that this is what I think. This is not what I know. I'm trying to transparently say that because I know there's a lot of brand new traders who just pulled up this stream. They're new to trading, and hey, welcome. This stuff is way harder than you ever thought. That's your warning. Second of all, the base case that I have is that we've had a lot of strong economic data out of the US. I'm pointing to things like higher than expected PMIs, unemployment claims that came out, better than expected. And at the same time, we have things like retail sales, advanced GDP, earnings from some of these big tech names have overall been pretty good. So all of these things combined, the economy seems to be pretty strong. So my argument for why the dollar could strengthen is if the Fed says, hey, that economic data has been pretty hot and let's not get ahead of ourselves and we don't need a rate cut just yet, the dollar is likely to move much higher, right? And what I mean by much higher is at least to this 103.7. But honestly, if we do get a very hard pushback on the rate cut idea, I wouldn't be surprised to see the dollar break out through the highs. And if I am dead wrong in my thinking that the Fed could point to this data and say that's an area of inflationary concern, right? And what for the new guys, why is the strong economy? Why would the Fed be cautious about that? Well, if the economy is really strong, it creates price increases, which if you remember, if you've been going to the grocery store or to the gas station, it's been shell shocking you, right? The prices are the sticker shock. That's because of inflation. If the economy is really strong, it actually contributes more to inflation. So the economy actually, they want the economy to kind of cool off a little bit. And if it's not yet cooling, there may be a pushback from the Fed. If I'm wrong about that and they say, well, inflation's still kind of overall coming down, we're okay with progress and the economy being okay is okay, we probably see the dollar breakout. And that's why today is so pivotal, guys. That is why everything is so important to watch here today. And I do hope that if you're serious about this stuff, you stick around with me for the next hour or so as we go through all of this. We're going to be reacting live to the commentary. We're going to have guests on who can help us with this and so much more. So it's a very, very key and pivotal day. I do want to take a quick look at the COT data and give you guys an overview of where we are at in terms of big money going into this event. So in case you do not or have not used the COT data before, well, it doesn't want to load right now. Let me just refresh the page. In case you haven't heard of the COT before, it allows us to look at what institutional money is overall buying or selling. What are they in? What are they out of? Et cetera. And also, why do I have two tabs open for this? Let me get simple. Okay. So here's the COT data. We've got it pulled up. And what we can see here is that overall, there's a net positioning on the long side of gold, which I think was interesting. You have a big bullish overall view on gold in the net positioning from institutional traders. So smart money is long gold. They're long the ZAR, the Nikkei, oil, the US 30, the euro, the pound. They're selling or bearish on the bond market, the Japanese yen, the Australian dollar, the SPX, CHF, CAD. Okay. So that's our net positioning. But what about the latest report? We got the latest report here recently. What we can see here is that they bought things like oil, they bonds, even though net positioning is one thing, but what they did in the most recent is really, really important. So for example, they bought oil, they bought the bond market, they bought the Nikkei, they bought the CAD, they bought the NZD. On the flip side, they sold silver, platinum, Swiss franc, NASDAQ, euro, Aussie, pound. Okay, so my point was showing you this. This is where institutional money is positioned ahead of this report and ahead of the jobs number on Friday. Okay, we'll get the latest filing of this on Friday as we get the weekly report from the COT data, and then of course our software here will help us to visualize that in real time. I also want to show you retail positioning. While we look at institutional money, we can also see what the retail trader is thinking. Feel free to pause the live stream if you'd like to take a look at a particular asset that you're favorable towards. Things like gold, which I know a lot of you guys trade about 50-50, so there's not a huge bias here. UK 100, pound USD, euro USD, kind of 50-50. Where things get more contrarian and you actually get a contrarian signal is things like oil, the Australian dollar against the US, Kiwi dollar versus the US dollar, dollar Swiss, and then all the indices, which I thought was really interesting. Pretty bearish sentiment from retail traders giving us that contrarian bullish signal. Very, very curious to see that. So yeah, bank forecasts. Also, we added this feature recently. This is something to think about as we get closer to the report. For the currency traders out there, where's the euro going? Where's the pound going, right? Well, if that dollar strengthens, you could probably bet that you'd see a breakout through the lows on the euro and vice versa. If they see, the Fed cutting rates in March, if that kind of becomes the expected, get ready for a rip higher on the euro. That's why today's number is so key. Speaking of the euro, it seems like we've got all the data here from, look at this, all these different banks on the left. These are their research teams: CityFX, BMO, BNP, Bank of America, CIBC, Goldman Sachs. We've got all of these, National Bank of Canada. We've got all these banks and their projected targets for the euro. And by the way, you can select anything you want here off of our data list. You can look at Bitcoin, pound USD, and Kiwi dollar, dollar CAD, and you can get the overall forecast. And we do also have gold, by the way, as well. Average target is 1.08. Quarterly target is 1.09. So worth mentioning that banks kind of see overall a weakening in the euro. 1.8, by the way, guys, that's down here, right? So 1.8 is kind of the approximate target. So they're thinking there could be a big push lower. And I thought that was really worth mentioning as we approach the event. I do want to mention, if you have not already heard about the Edge Finder before, and this is your first time on a stream, or you're somebody who watches regularly and is considering getting a copy, your chance to do so at a super discounted rate is ending very soon. We are currently doing 45% off the Edge Finder. If you have not picked up a copy, this is your chance to do so for the biggest discount that we have ever been doing ever. I mean, 45% off is the peak. So if you would like a copy before that flash sale ends, take advantage. We've got a link here. Click this link, send a direct message to our team. Someone from my staff is standing by. I've got real people in the other room who can help you get a copy. If you're thinking about getting one, use it to help you trade better. Again, the idea is that you have more data to make better informed decisions with your trading. So take advantage, click that link, chat with a rep, and get a huge discount before that sale price goes away, that flash flash sale is ending. And in case you're wondering what that link takes you to, it's just a chat bot. So, or not a chat bot, a chat system where you'll be speaking with someone who is not a bot. You'll be speaking with a real person on my team. Just click Edge Finder 45% off so you can lock in that discount and start a chat. So if you're interested, take advantage there. Again, the euro definitely going to be an interesting one to watch as we get closer into the event. Look at oil selling off hard here. I took a loss, like I said, on this one, small loss, but happy to get out of this trade if it wasn't going to work. I mean, I've also, to be fair, I have also been catching a couple different long trades. This is the first one that didn't work. So we'll take it on the chin and move on. Also watching the indices continuing to come down here off of their highs, SPX as well. The Dow, the lead of the three, just barely flat on the day. Really quite interesting. The Russell taking a bit of a hit there. You've also seen gold rally here this morning. I thought that was really interesting, a big push up overall, and silver, kind of staying flat. So the commodities world's moving. We also have, again, a lot of tension built up here for these currency pairs as what the Fed chooses to do here with their, their outlooks for rates is everything, right? If they forecast or they sort of lay out that they think that March rate cuts are coming, it's going to be a totally different story than what I'm thinking, which is maybe they push back quoting, hey, we've had some hot data overall. Maybe we just take a back seat and we wait a bit longer. And markets are torn. There's a debate either way on what's going to happen. So maybe to help us with that, we do have somebody who is a special guest on the show. He's coming back, and we're going to see here in just a second, Chris Pulver. So we're going to take a quick break. We're going to set up the cameras so that we can speak with him about this. Chris Pulver is a welcomed guest, and you guys will definitely love his commentary. So stick around. We'll be right back just after this.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, guys, and we are back with Chris Pulver. Hey, Chris, how's it going, man?
Nick, what's happening? Happy FOMC day. Nice to be here.
Yes, good to have you back on the show. And Chris, this is like our, I guess like our fourth or fifth time doing this together, which is absolutely awesome. And I'm glad that you're here to help us prep for this. Again, FOMC is always a big one. And we always look forward to kind of setting up for this. And we always, preface something to our viewers here. So you obviously know there's some new traders in here. There's some people who have not been doing this too long. Please know something about FOMC. There's likely to be some volatility at the start of the next hour, and it will probably last for several hours after that. However, there's probably not going to be a spike at 2 p.m. in 12 minutes or so. And if there is, it's unlikely to really substantially move one way or the other for too long. You have to be careful, right, Chris? Because it's really all about that 2:30 press conference. Is that what you're thinking?
I think today is really all about the press conference. And the reason why is it's January, the next rate decision's in March. And this is the first time for Powell to come in and really set the stage for what just happened in November, December. Because
yes,
all these rate cuts that the market expects have essentially been priced in from that big holiday rally. So if Powell doesn't really love that, then he can come in and really, throw some cold water on this market rally as we broke new highs and we keep melting up. So I think, there's technically reasons for the market to fall back and correct a little bit. A couple things. We'll dissect the FOMC stuff first, but yeah, I think Powell sets the stage. And I don't know if you've been watching the CME watch tool, that Fed watch tool. It's changing quite a bit. And so I just looked at it this morning during my live session and just before I came on with you guys this afternoon. And now the market is expecting a rate cut in March. It was actually flipped where there was going to be another pause in March. Now it's flipped back to a rate cut in March. And I think Powell kind of sets the record straight with setting the tone for today.
Yeah, and you can see it, Chris. I mean, take a look at yields, right? Yields are where that Fed watch tool even really gets its bearings. And you can see that the 10-year yield dropped precipitously here in the last several hours, which has really swung the odds on that Fed watch tool. I think it's going to be interesting because you made a really good point there that I haven't really been pointing out to the audience as of yet, which is, guys, we saw a massive run up at the end of last year, right?
Yeah.
Like just a monumental, really unusually large rally in the stock market, and that was off the idea that the Fed had kind of turned more to the dovish side, and now things are going to be hunky dory from here. Well, as you pointed out, Chris, that's a really important thing to look out for. Is how is the Fed, and notably Jerome Powell's speech towards this recent price action on the markets, how is it going to impact? Because of course, if the market's super excited, super optimistic, and they, massively pump the markets, that's stimulus in itself, and it could actually act to, boost inflation in some ways, which is of course what the Fed has been all against. So it's going to be interesting to see because although yes, the Fed watch tool is moving all over the place, Chris, it's kind of like, the volatility is very high. It could very swing back both directions based on what we hear. So I guess, what are you looking out for? What, as we get closer to the press conference? Of course, we've got 9 minutes till the rate, which is expected completely to remain unchanged. What are you looking out for from Jerome Powell himself?
Yeah, you had the chart up. The chart that I'm watching the closest is the DXY. I think watch the dollar to really get a gauge where once the dust settles, because FOMC is going to be pretty noisy. The rates expected to be paused. And in crafty, Powell fashion, he's probably not going to be super explicit one way or the other. He'll be very calculated with how he delivers the message. If data shows we might raise rates, we might raise rates. If data shows we can cut rates, we might cut rates. We'll be accommodative. We'll be restricted. We'll be data dependent. The one thing I think that's going to be interesting is, like I said, technically, I'm looking at higher time frames, daily, weekly charts. We're nearing those overbought conditions with divergence on all the indices. I think I looked at the percentages today from that October bottom and that November, December rip. The Dow was almost up 20%. The NASDAQ, I think, is still clinging to like 22% gains. The SPY's right at like 19-20%. That's a big rally that goes unchecked for now 3 full months. And even this year, as we got into the year without any earnings, it just kept melting up. And it felt a lot like last year, where what's driving the market higher? Mag 7 stocks. It's the large market cap, the top 10 stocks. It's not the broad market. So that's where I'm interested in a couple of things, and I want to get your take on this.
Sure.
So we've had a lot of earnings the last couple of weeks. This week is all about Mag 7 stocks. We have the next couple of weeks. There's going to be like 400 next week, and that maybe like 600 or 700 the week after. Once we get through the earnings season and give the broader market a chance to speak up and show how they're doing for the overall, earnings reports, I do wonder if the Fed starts to show and the market starts to believe that this rate cut cycle is really aggressive and going to happen for 2024. I do wonder if investor-wise, people start leaving those money market instruments, those 5.5% yields for the 12-month periods, and they start going back into equities and bonds. Because you just showed the yield a second ago. You showed the 2-year yield, the 10-year yield. If those are dropping, that means bond prices are up. So for the bond investor, this is a great time to be long bonds and possibly lock a 2-year, 5-year, 10-year note where, if you've got the time to sit on it and lock in 5%, and we're in deflationary environments for the next couple of years without crazy sticky inflation, I mean, there's fixed income that can benefit from this, and there's $6 trillion that will be leaving money markets coming back out to look for some more risk appetite.
Chris, and you made a great point there too, because as this yield drops, all the money market people, for those of you guys who don't know what exactly money market is, or it's basically the risk-free stuff you can get when you just park money in a bank. There's a lot of it. There's a record amount of it sitting on the sidelines in the last few years. And the reason that is so impactful is that when you see rates, the yields dropping like that, what that's going to do is it's going to light a fire under, the people who are sitting on money markets. They're like, okay, my money market is not making me nearly as much to sit risk-free. I got to deploy this money. And we're not talking about like, a little bit of stimulus. We're talking about I think it's like over $1 trillion sitting in money market accounts. And to Chris's point, Chris, if they push that money into equities or bonds, or one or the other, more preferably. Like if one gets pushed hard, like for example, if they start rate cutting aggressively because people are real fearful about, you know, perhaps a recession actually starting to creep in, you're probably going to see a lot more money go into bonds. Whereas if you see, you know, rate cuts because we can, and soft language from the Fed, but, you know, still a rock solid economy overall, you probably see a lot more in equities. I think we're going to get a little bit of that here today, as well as with Friday's jobs data, and should be really interesting. So, Chris, we've got about 5 minutes here before the rate gets dropped. What, if anything, are you trading right now? Do you have any trades on ahead of it, or pending ideas for trades after the math?
Yeah, so I am neutral on dollar pairs. The only dollar that I'm in is dollar Swiss long. I think that the DXY is so choppy for the last couple of weeks that I'm just going to wait for the dust to settle on re-engaging in dollar crosses. I did take a couple of stabs at Japanese yen pairs. I've got a CAD yen, Euro yen, pound yen short. Currency strength today. The Japanese yen is actually on top of the food chain, which is nice to see.
Yeah.
But I don't really trust it. I think the Japanese yen can turn right back around and be weak tomorrow, or maybe there's something more to it. I don't know. Everyone's trying to call this Bank of Japan timing, which I'm not. So I posted this morning trades I like. It's not dollar related. It's not yen related. The trades I like, I'm looking for Euro Aussie long, pound Aussie long, pound New Zealand, Euro New Zealand long. I like all those to the upside, looking for some nice confirmation on some trending systems. And that's about it for the Forex side. Other than that, I've got a lot of earnings plays in. I took some profit today. I had about a 47% gain on my position for Google this morning. And I've got AMD. I'm trading Meta and Amazon. I protected my downside in case the Fed's going to, you know, remove the floor a little bit for maybe the next week or two. My expirations are out to next Friday.
Did
So
you
protected
did you
myself.
sell puts on, or did you buy puts on Google? Is that what you did?
I did both. I did a
Oh,
I did
nice.
a fancy name for it. It's a reverse iron condor. I essentially did 2 debit spreads where if it went up or down, I had some money to be made. So I
Very
paid
cool.
I paid like 589 for the trade, and I closed it out today for 870. So just shy of like that 55-60% target. So I did 47. It was before FOMC, which is good. And I'm giving the market time where I know we have FOMC today, we have non-farm on Friday. Give me a week into February where the market can get some traction, and I'm just looking for some direction. That's all.
Fair enough. Yeah.
Yep.
No, that's a big week, Chris. I mean, between earnings, NFP, the Fed, I mean, you couldn't have asked for a more, you know, wound up week, and to
Yep.
visualize it as one big spring here. And
Yep.
guys, we are at just a couple minutes here. I just want to reiterate what we said earlier. In 2 minutes or so here, we'll get the Fed funds rate. This is widely expected, almost guaranteed to just remain at 5.5%. So please do not be surprised if, you know, the choppiness here in the next few minutes here could be all over the place. You could see a spike one way and come right back instantly. So, you know, most likely that's what we see here. The big thing here in the next few minutes could be the statement. What we get here is basically you know, a statement from the Fed, what that could have, and then the press conference there at 2:30, which we'll pull up on stream for you guys. So, Chris, we've got 2 minutes here, and I guess question for you: do you have any thoughts on gold for people who are gold bugs in the room?
I see a lot of people in the chat mentioning gold. So
Always.
gold and silver, Nick, to me might be one of the best looking trades for my 2024. So I'll say this: I think gold is noisy right now, but if we can break above 2100. I think gold is going to 2500. I think there's another 25% upside to this blow off level. I see an ascending wedge, which means we keep testing resistance. I don't think it's going to hold. And if we cut rates and there's a reason for, you know, more dollar printing or a weaker currency, I think the alternative is people are going to flood into gold. I mean, Bitcoin has ETFs now, so we'll see if that becomes another, you know, alternative option versus the dollar. But to me, gold upside, silver upside have tons of potential. I'm just trying to be patient. I think that if I ideally set a price on gold, I want to buy it at 1900 and at 1800. And that's about it. But if it's going to break 21, I'm going to follow the breakout and go with it. So it's got to clear 2100 pretty firmly, like daily, weekly candle. But I think from there, we're blowing off these highs and we're going towards 2500. I've already measured the move out. Let me see where it is on my chart. It's 24, got about 2467 on the upside for a measured move. It's pretty exciting.
I mean, yeah, I think I was listening to someone recently on one of our 8cap webinars I was a part of, and let me not miss this move. We got 30 seconds here to go.
Yep.
He was pointing out that there was like this bursts, consistent bursts of like 10% each time on gold, which I thought was really interesting. It was like these 10% legs higher than a pullback. And we'll get back to that in just a second. We got 10 seconds here, guys. Breaking news coming in now.
Yep.
All right, guys. And we're just looking at all the charts here just to keep an eye on it, just in case we get some sort of big move. Let's see. All right. Euro down slightly, gold down slightly here. NAS slightly down, SPX, dollar index moving higher. And again, guys, right now, what you're probably seeing, the algos are probably going all through that statement there that was dropped from the Fed just moments ago, which could create, like I said, some volatility as interpretations of that start to form. Dollar index is still finding its bearings off that 103 area, pushing higher. Gold coming down here. Euro coming down. NAS also down. SPX just shy of taking out the lows of the day. Really interesting to see that. Dow actually joining the fun, as in the not fun, the selling parts so far. So we'll continue to watch that. Chris, if you see anything on your end, let me know. I'm happy to share it.
Yeah, I've got the SPY, the Qs, and the DIA up. They're all selling off. So I'm just curious to see that's translating. Just like we said, dollar index is up, major index is down. You're getting that pretty strong correlation, Nick, where it's inverse related, but dollar strength equals stock market selling off a little bit. And again, we've mentioned this before when we've done these sessions. I mean, the 2 p.m. to 2:30, it's kind of its own window to trade. If anybody's getting into the mess here and getting into the trenches, and then 2:30 onwards with the press conference can be the complete opposite. There might be just a big noisy candle at the end of the hour. So just be careful on this FOMC stuff. Like I said, I'm using this window for now to Friday to next Friday to just see some volatility on some of the stocks that I'm trading, the options that I have. So that's what I'm embracing. And I know that this is just part of the game. You just watch the fireworks, see where the dust settles. And the good thing is we get to see it all happen in live.
And again, Chris, I think out of the times that we've done this together, this little blip right here, this first 2 p.m. drop, I would say, just anecdotally off the top of my head, I think it's like 80 or 90%. Like we've done it, let's say we've done 5 times, 4 out of the 5 times. By the end of when we wrap up together, the candle has like a race back. So
for sure.
Yeah, like most of the time, it's just going to not make a full move. There was like one time, I think, in recent times where it actually did make a meaningful move and sustain itself in the first 30 minutes there. So, but again, it's all about the press conference, because that press conference is going to give us some guidance going forward. Chris, question for you.
Quick comment. Can I drop a quick comment?
Go ahead.
I'm looking real-time stuff here. So decisions stay the same as expected. The first headline that I read here, the Fed does not expect it will be appropriate to reduce rates until there's a greater confidence inflation is moving sustainably towards 2%. So right there, it's like the initial tilt is a bit more hawkish, and it's like this is the firmer language where the market's not going to like this. This is why we're seeing the indexes sell off the way that they are. The dollar's going up. It's just to like put this rally in check a little bit. I think that's what we're seeing right now today.
No, Chris, I think what you just said there's twofold for me. It's exactly that. The concept that, hey, we've seen this massive pull forward rally that, is not sustainable and actually can be quite stimulative and actually reverse the effects of the Fed's, war on inflation. That's step number 1. Step number 2 is same with the economic data. We've seen advanced GDP, 3.3%. That was hot. PMI numbers, retail sales numbers. There's been a lot of strong economic data, which again, I feel like there's a solid chance that we hear some pushback to your point about the big rally that we saw. Combine that with economic data. I think that the Fed watch tool, yes, it might be 60-40, but I think there's a little bit more. It's probably changed now as we've gotten that right there. So
yeah. And again, you want to look at the CME watch tool at the end of the day. It's enough. There's enough noise today that it could change and we could have it flip right back around. But we've said this before. The rate was expected to be, unchanged today. That was a 90% probability on that watch tool. That tool has not been wrong since 2009. There really are no surprises with the Fed's. The Fed's mandate is price stability and you can say transparency, but anyway, that tool changes enough over, a week out or 2 weeks out that it's pretty accurate going into it. So it was just interesting to see it jumping from like 40 to 60, 60 to 40 and going back and forth. And, we come into March's rate decision, it'll have a clear winner. That most likely will be the case.
Yep. No, you're dead on with that, because it's again, at the end of the day, the Fed's looking at a lot of the same data as we are, right? They're looking at the labor market, they're looking at PCE and all sorts of different variables. So, but interesting to see. I mean, dollar bulls, we've seen at least a hold here at that 103 mark for now, and I mean, for the most part, Chris, it would be perhaps the reason we're seeing this move right now kind of sustain itself is that it would be wild if that was the statement, and then Jerome Powell came out and said, actually, you know what, March rate cuts are coming. So you can see the swing in front of us where it's changing probabilities, I suppose.
Yep. Yeah, it's going to be interesting. I mean, like I said, it's just the first FOMC of the year. It was a pretty quiet Fed through November, December. They just kind of let the market rip. I mean, the data was proving really solid. The U.S. numbers were showing a lot of resiliency. And to all the perma bears out there, it's like, this is one thing that I also don't want to do. I don't think anybody should be forcing positions on a one-sided narrative. I am so directionally neutral, and I I hate it because I have to take trades where I'm trading both sides, right? Like I'm in positions right now where if the stock goes up or goes down, I can make some money. I'm in position right now where I don't want the stock to go anywhere because I want it to stay sideways. Right. That's how I'm trading my portfolio. I have to do that because I don't think that at all-time highs, it doesn't feel good to buy all-time highs. It never feels good to buy all-time highs, and at the same time, I can't say that the market can't go higher because that's insane. The market wants to go higher. And when you have forced buying with 401ks and pension plans, it's going to force the market to go higher. If times are fine, it's like, that's why the bulls climb stairs and bears jump out of windows, right? That's true. Unless there's a real catalyst to just drain this market down and have this huge scary outlook, I just like the market's going to keep grinding away. And last year, and we've talked about this, I mean, we only had 2 broad market rallies last year. It was May and November and December. Like that window, you had about 2 or 3 months of broad market. Everything else was Mag 7. Yep. So coming into this year, it felt like Mag 7 all over again. I mean, the S&P is up, but your communication sector, your tech sector are outperforming. The stocks
just take a look at the
20+% are tech stocks.
Yeah, to your point, the RSP is just barely getting to the highs. There's your equal weight S&P 500.
Yep.
So,
and that rip was impressive because going into October, it's like, look where that thing was. That was down. It's like that was an awesome trade. In the IWM, small caps had this huge catch-up trade, but they're not making higher highs. Right. So, I mean, everything is at higher highs. The Dow, the NASDAQ and the SPY's at higher highs. The IWM's pulling back. So again, I mean, CME Watch will be interesting to see things shift around for March. We'll see. But I think there's enough money out there that, and not only that, one thing that keeps getting overlooked is we focus on the Fed. You have to remember that there is a ridiculous amount of fiscal policy going on right now that is putting more money into these markets. It's not just monetary policy, right? The Fed has been pretty clear on their stance. They've had a big enough battle over inflation. And I mean, I will say, look, I give the Fed a lot of credit for maybe getting really lucky, but they have navigated this environment pretty well. And I hope that at the end of all this, it doesn't have to be like a, Volcker type raise rates to 6, 7, 8% to just extinguish inflation if it starts to rear back up. For right now,
Chris, I want to add to that point because there's your market history, a real thing here to think about. I am on the surface, you might hear me saying, I think, rates are going to stay, and that might come across as bearish, but I actually am a true bull overall this year for the reasons, basically, I think that we should rate cut, but I don't want us to need to rate cut. That's the big difference here is, I'm okay with the economy. I think good news right now is good news. And I think, we saw a little bit of reaction to that, Chris. This morning, we had ADP, the private sector, reported their jobs. It wasn't good news. Indices sold off. I was actually like, okay, I'm good with that. I'm good with strong economic data pushing the market higher. And weak economic data pushing the market lower. And for the newer traders in the audience, they might say, well, duh, that makes sense. not for the last, year or so. It's been the opposite. It's been a lot of, you see cooling in the labor market, and that's good for the stock market, right? But we're kind of getting to a point where I think things are returning to a bit of normalcy, and that's the way I think it should be. So I actually want the economy to stay buzzing overall, just not too hot that it re-invites that inflationary environment. And I think that if you cut too soon, which is probably exactly what the Fed's thinking, right? That's what they said in their statement. We don't want to cut too soon. It's going to do more of what we just saw in October, November, December, where you had this massive, stimulus-inducing rally in the indices. But Chris, you brought out some wonderful points there. Look at the Russell today, probably one of the most, if not the most sensitive of the major indices to interest rate, cuts or levels, right? So this clearly telling you, if you're looking solely at the Russell, that the probabilities of rate cuts in March just got slashed slightly. So you can always look at the Russell. Same thing with gold, and as we just discussed earlier, yields as well. These are incredibly sensitive areas of the markets that will move dramatically. I mean, yields, you don't get any closer to that. So definitely interesting stuff. And Chris, I want to say thank you very much for coming on the show. We got a lineup here of things to get through, and I know that you helped us navigate this as you've done in the several other ones. I know you're a busy guy, so thank you very much for coming on the show. And I do want to say to our viewers here, our guests, they come on as volunteers to help out what we do here. And we want to make sure that we return the favor for their help. If Chris was someone you'd like to hear more of, he's got a regular show that he does on his own YouTube channel. We're going to drop the link to that here in the chat for you guys. Do me a favor, do the show here a favor, and go show some support to Chris. Make sure to go subscribe, find him on socials as well. And Chris, thank you very much for that. I'm sure we'll be chatting more soon.
All right. Always a pleasure, Nick. Thanks, everybody. See you.
See you, Chris. Yep. Always good to have Chris on, guys. Again, really, really smart guy, and love his commentary. Points he was making about the RSP, taking a look at just various unloved areas of the market that tell you a story, right? If you look at just the NASDAQ, as Chris was pointing out, the MAG 7, for those of you who haven't heard before that, it's really the MAG 6 now. Chris is hearing me. He's probably thinking that's funny, right? Tesla got left behind, got absolutely obliterated. So maybe it's the MAG 6 now, but we're talking about companies like Google, Microsoft, Apple, Amazon, right? These companies just killed it in 2023. And a lot of other areas were left behind. The question now is that, you saw for the stock guys, stock girls, here's the thing. Google and Microsoft, they both beat bottom and top lines, and the market still sold off Google hard. These companies, what concerns me about, I'm a bull overall in the indices, but my concern is that these things are priced so tight for so much perfection that any chance that they disappoint in any way, shape, or form, they get just absolutely beat over the head with a bat, right? So that's what happened with Google. They had some disappointment on the YouTube side of things during the holidays, and just one slight little disappointment, and Google gets sold off. And I think that that's reflective almost of a lot of the market as a whole. I think, you've got a very richly priced market, and I'm still, like I said, I love these companies. These are companies I want to buy and hold for the long term, but got to wait to trade them, I think, with some respect. The NASDAQ, I am looking at levels like 17,000 for an attempt to buy. I mean, it's not like it is massively difference in valuation at that level, but you can't deny still that these companies demand a good premium for a good reason. I just don't want to buy them at the highs. So I'm waiting for pullbacks, looking for opportunities. The S&P 500 here did just barely tap into this 4870 level. I think it just barely missed that level, but came down briefly. Again, guys, we're about 15 minutes out from the press conference from Jerome Powell. That should be a very market-moving event. Quick look at the dollar index as we basically pared our losses there on the day. For the most part, we've swung back to slightly here. But again, you might be wondering what changed. Chris did a good job. He helped us out with something. He pulled up the fact that from the statement, from some of the headlines, we essentially saw there was some pushback again on the March rate cut stuff, which was what we were talking about ahead of time, but it's too soon to say. We still got the press conference, still might hear something that could be very changing to that narrative, and the dollar could break lower. But for the most part, I would say that so far what we've got is a little bit more of a less dovish sounding Fed, right? Dovish being March rate cuts and less dovish being maybe pushed back to the second quarter or so. Yeah, so interesting to watch. Take a quick look at gold here. Gold pulled back slightly off of that idea, but has gained a little bit back. I think Chris mentioned that this could potentially be a bigger mover in the 2024 year. And I actually agree. In the second half, as you start to really see rate cuts come into the picture, gold could fly. And you know, we've talked about this for a long time. But if you are looking at gold as a possible opportunity, I think in my opinion, you'll probably have several opportunities along the way, right? When gold really gets moving, it sustains itself for a very long time. Look at the weekly chart and you can see that to be true. You know, when these big run-ups, when you have these, massive stimulus periods, gold can really run hot, especially off of fears of inflation, resurfacing, things like that. They're very well, could be something there. So again, got a little bit to go here before we do get into the press conference. We're going to pull it up on stream for you guys. It should be a lot of fun, and we'll go from there. I do also want to mention, while we're on the topic of gold, let's take a look at what institutional money is thinking about gold. We've got some bank research teams here that I think is worth mentioning. So check this out. We got like Citi FX, Goldman Sachs, TD Securities Research Team, UOB, OCBC. I don't even know what that is. Point is, these are lots of different research teams that put out their forecasts for various markets. We've got gold here selected. And what we can see is that they do actually expect probably some short-term dollar strength. That's actually been a theme. We talked about that earlier when we looked at the EU, right? The euro dollar. There was some bullishness baked into their price forecast. What we can see here is, when looking at the gold market specifically, 1972 is a monthly target. I think that there could be a strength to the dollar in the short term that could drag gold lower. But in the second half of the year, if we do start to see those rate cuts do come into play, which is kind of the consensus, very likely that you could see gold finally have its day in the sun. It's been really range bound, choppy. Short term, I think it's still got some pressures ahead of it, as I think other companies do as well. I am overall bullish on indices, but just really needing the pullback, right? It's tough to look at these markets and say, hey, that's just going to keep squeezing higher, right? Can it? Absolutely, it can. If you think that cannot squeeze higher for another few weeks, then you haven't been playing around in the markets long enough. This stuff can be relentless for a very long time. So I'm not saying that it can't go higher, but I personally am only really intrigued in trading these things if we do get a reasonably sized pullback on things like the S&P to like 4,800, the NASDAQ to 17,000. That's from a trader's perspective, that's kind of where I'm at. The Russell taking on some water here, again, off of the idea that rate cuts are not as expected in March. This is what we've been saying for days now. That's been my outlook. We'll see if I'm right, because I still could be totally proven wrong by what the big man himself says. If the statements from Jerome Powell during the press conference lean into the idea that, hey, rate cuts, are not off the table. We're not, we see them coming still. Like, they're more decisively overall dovish. If you get something of that, the market might sniff it out, and areas that are more sensitive to rates, like gold, the Russell, etc., could actually rally. However, again, like I said, I think, and I've stayed pretty transparent about this. I've been pretty consistent about this. I think the Fed is likely to point to the strong economic data. And as Chris pointed, this was a wonderful point that he made. The end of year rally is stimulative in its own right? Company, there is significant stimulus that comes from stock market rallies. And so this huge stimulus that we saw, combined with economic data that's been pretty strong, could cause some concerns. We've seen this historically with the Fed. They do not want to repeat the process of thinking that inflation is over and then letting stimulus come in, and then inflation fires back up. And if that happens, boom, you've got problems. The markets sell off way harder. So again, lots of stuff to look at. We've had a request in the chat here to take a look at the VIX. Let me just look at the VIX here. VIX is at a multi-month low, and in my personal opinion, it has room to squeeze higher. Now, can it go lower? It totally could, but I think the probabilities of a VIX staying low, especially during an election year, actually VIX futures are expecting the second half of this year to be higher in volatility. And who's to say who would, whether you like XYZ candidate, I'm pretty sure we can all agree that volatility will likely be high at the Thanksgiving dinner table due to elections, right? So carries over into markets, and it would make sense that the VIX could go higher. That is kind of the consensus we see, a higher VIX this year. And again, should be interesting to see what that could do potentially to markets. In just about 10 minutes or so, we'll be joined with Frank. We'll be watching the press conference with the man himself, JP, the wizard behind the curtain himself. And one thing that's kind of interesting is that you're seeing these pullbacks ahead of the press conference. These moves, I think when we heard from what Chris pulled up, the headline was that, they're going to remain careful about rate cuts too soon kind of thing. I think that could be the fact that could be the case that if that's their stance in the statement, it could carry over into the press conference where we hear from Jerome Powell, which again would indicate that perhaps indices take on some further water and that the dollar can regain some strength. But so far, markets seem to be poised, still setting up for that event. We've still got kind of a range-bound dollar index, and I'm still kind of waiting for a breakout one way or the other to make a decision. I mentioned this as well. If we do get something that is incredibly dovish from the Fed, the old mantra, don't fight the Fed. If we get something that just crushes the dollar bull hopes, I will probably change gears and, change my tone a little bit. But right now I have my bias, and we'll see if that plays out well. US 30, this is the Dow Jones. Dow Jones is the top performer of the three right now, as perhaps it is the least sensitive to some of this stuff. The NASDAQ being, of course, tech heavy, and especially with price to earnings being so high for some of these companies, it is possible that any sort of hiccup could really cause the NASDAQ to slide. Same thing with, like I said earlier, the Russell, which is going to be your more interest rate sensitive areas of the market. Oil came down hard here. I mentioned this earlier. I tried to buy oil. I bought it a couple times before this, which worked out well, but this last time did not work out. I sold out for a quick loss there on oil. Thought we would continue higher, but did not. Gold jumped this morning, is pulling back here a little bit. But overall, I would say that this is an impressive breakout for gold. And if you do get rate cut optimism, like if the market kind of sniffs something out there, gold would be, in my view, something interesting to watch because it's been so range bound and has not seen a lot of love. If you do get truly consensus as rate cuts are coming and they're coming in strong, really could be a push for gold. Vice versa, any squashing of that idea is going to be struggle city for gold. So let's keep going here for a second. Dollar yen sold off hard here off of this morning's ADP numbers. The private sector basically hired less people. That would totally explain why the dollar saw some weakness. Weakness in the labor market, generally speaking, is going to be a little bit of a weakness for the dollar. It also took yields with it. Yields dropped hard on the 2-year and 10-year, and you can see that here reflected there. That really dragged things like the dollar yen down and gave a little bit of boost to the pound and the euro. But again, we're still seeing a mixed sentiment here until we get Jerome Powell, because we saw this swing back in the direction of the dollar favor for now, off of the idea that rate cuts might not be coming in March. We'll keep watching here. We got the Australian dollar here, pretty range bound. Kiwi dollar, still range bound as well. TLT, here's the bond market, ripping overall, but pulling back just recently off of the yield bounce here that we might have been seeing just in moments ago. And again, I think the biggest signal from a price action standpoint today, Chris said it best when he came on. The first thing he said is you had it pulled up, the dollar index. It is really, truly, do we get a break up or down based on what happens? And I don't claim to know that sort of stuff ahead of time. I have my opinion and my bias. But just like, I say this, this is my joke that I've been saying recently. I got to stop saying it because it's not that good. But just like any good person in a relationship, you got to know how to admit when you're wrong. Same thing goes for trading. I think the dollar index should strengthen. We've seen strong economic data, but if we hear something to the contrary, you got to admit when you're wrong. You got to move on. Holding on to losers is a tough way to play this one, in my view. This market has a lot of potential to move strongly in one direction or the other. And again, if this dollar index breaks through the highs, watch out, because I think that could lead to further upside. Let me also here, guys. Frank is in the back room. Frank, we'll bring you in just a second. Let me ask you a favor. If you have any headlines that you find from the statement that you could bring onto the show, that would be awesome. I just want to prep that on your end. That would be awesome, just because, again, I'd like to see it myself. The VIX trading at 6% up on the day. Big spike there. And to be said that it actually could spike a lot further depending on what we hear going forward. But Russell down 1.2 at this time, almost taking out the lows of the day. Here's your 15-minute chart, the 30-minute chart. I'm sorry, the US 30 also testing lows. NASDAQ not quite at the lows, had a pretty good bounce there. The S&P 500 taking out the lows and trying to hold on to them now. Silver selling off here. Gold really reversing. And again, I would imagine that if you don't hear something to the contrary of what we just heard, gold probably goes much lower. We'll see, though. That's an interesting one. I've mentioned this, I like the NASDAQ on a bigger pullback, but we're not quite there. It's a trade setup that I personally am watching. Oil, will I try this one again on the long side? I'm going to let the dust settle on that. I've traded this one a couple of times. The breakout here was wonderful. I caught a couple moves to the upside. I took a loss today on oil. So I think I had 1 or 2 wins. I can't remember. 1 or 2 wins on the way up, and then took a loss here this morning as price broke back the other direction. But I'm happy to be out of it, especially with the volatility that is coming. So real quick, guys, we're going to take just another 30-second break or so, get Frank set up here to join us on the show so we can get ready for the press conference. I can see that the editor has it all loaded up for us on the show. So stick around. We'll come in right back just after this.
We have 4 brand new indicators built for TradingView. Introducing the momentum, extension zones, trend projections, and volume spikes indicators. All 4 indicators work on every TradingView chart and time frame. You can easily see shifts in bullish or bearish momentum. Look and see if price is being overbought or oversold, which could cause a quick reversal. Automatically get a trend line that shows the true trend, bullish trend, and bearish trend based on the most recent market data. Get notified instantly of big spikes in volume to help you find breakouts. All 4 are available now at a1trading.com and can get set up in just a few minutes. Go check out our brand new line of TradingView indicators today.
All right, guys, and we are back. We got Frank here pulled up now. Hey, Frank, how's it going, man?
Hey, what's up?
Second time we're doing this today. What did you find? So we just had the statement. Was there anything that stuck out to you?
Well, a lot got changed.
Okay.
There was lots of statements and words, phrases just crossed out and replaced by new things.
Mm-hmm.
So what I saw was more confidence in growth, and that expectation that everyone had about rate cuts was, I guess, can probably dwindle now, because what Powell said in this was, we're going to keep looking at the data. That part didn't change, but until they have greater confidence in the movement towards 2% is when they're going to think about cutting. And so it's just like what we said, the momentum that you talked about wasn't there. For me, we're not even close to 2%. So why even think about rate cuts right now? So that kind of takes it off the table. I went over to the Fed Watch tool as well, and I noticed that the expectations flipped again. This is in March of this year. So the expectations in March flipped back from, I believe it was like 56% thought there would be a cut. Now there's 52% thinking that there's going to be a pause again. So I think sentiment is kind of leaning towards we're not going to get that cut this time.
Yeah, no, that's a good point, Frank. And I think you mentioned the momentum concept. I'll pull that up here on my end. The inflation data that we talked about, a week ago or whatever. We've been talking about this for some time. We saw inflation really meaningfully coming down, and then it's really been flat. And we haven't seen, obviously, the Fed sees kind of the same way that we're seeing it. It's like we're not really pushing down into that 2% target range. And with all the growth that we've been seeing on economic data, it's really key. FedWatch tool, somebody asked, what is this indicator? It is really, really key. It is essentially, it's using the bond market to forecast what bond traders are thinking about what's going to happen next with rate cuts. This was almost up to 60%, as Frank mentioned earlier, thinking that rate cuts were coming in March. With the recent FOMC statement that just got planted, we are back down to 45%. We're now about to go to the Fed and check this out. We're going to switch over. I think Chandler's got the screen set up for us so we can go live. Well, actually, are we? We'll come back to that in a second, Chandler. Yeah, there's an empty podium. We'll talk for a minute longer. But yeah, interesting, Frank, that they pointed that out. Momentum has kind of dwindled on the inflation progress bar, I suppose.
Well, they didn't point that out. I was just saying that you mentioned that, and that
Right.
was very clear in the statement when they said we're not confident until we get further movement towards our inflation goal. So it like very much complements what he said.
True. Fair enough. And okay, now we've got him on
My
here.
colleagues and I remain squarely
Here he is.
focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well
statement
anchored,
right there.
as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Sheila Smiley from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay, so what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6-month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that
Maybe he's talking about core.
What we think we're seeing, and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick.
Nick Timmeros of the Wall Street Journal.
He's also said more
It seems to
sustainable
me you
path.
raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see the economy turn down, because that will be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Bell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above, core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline. And the case is likely that it will continue to come down. So that's where it is. But we're wanting to see, more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates? Yes.
So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening in certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things, would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down. That's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering, moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including
rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rent. So of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me.
I love
do
this
you
guy, Frank.
believe the neutral rate is working?
I love this guy.
Right
He's on
now, that growth
CNBC.
is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important. And that is, a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles, and has brought that, working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest sensitive parts of the economy, as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract a sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate the neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will, but at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chain.
Is he answering the question?
So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
I don't know. He's a master wordsmith.
Thank you. Sorry.
I don't know what.
Thanks for taking the question, Mr. Chairman.
I don't know what that meant.
You mentioned earlier,
Mark's
we're not
reaction is
seeking a
real
weaker
mixed.
labor market. I think that you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic.
Wasn't
Even
this
with today's
question
ECI
already
levels,
asked?
they were still above those pre-pandemic levels.
I think the labor market by many measures is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think, job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
I'm starting to zone out. I don't even think I heard
Chris
what he
Rugaber
said.
at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that
That's a good question.
Solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk. The risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. We'll look at those. Last year was a surprise.
So he's saying that the threat of
Bloomberg Radio and
more or better economic numbers is a threat to inflation, but not in the sense that it will rise, but that it'll stay at where it's at.
Like sticky to where it currently is. Yeah. Interesting.
Very much. And you mentioned
below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
That was your
So
concern.
your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years. So it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. Is not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good
Frank,
picture.
I have to hop off. I got a
Your
podcast
second
I'm doing.
question was,
I might leave you
sorry.
to host the stream
Could
for a
you
bit.
get inflation that is below target? End up with
okay.
inflation below
It should just be a
target,
few
and you have
minutes.
to
You guys can
do
end it
something
whenever,
about
but
that.
I just got to hop on the
So
podcast.
the thing is, we're not
All
looking
right.
for inflation to tap the
See ya.
2% base
See ya.
once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
No. We muted?
Edward Lawrence from Fox Business. Thank you, Mr. Chairman.
Not
for making
yet.
this.
That's next
so as
episode.
I've heard from some
Next
district
episode.
Fed presidents,
What
is it, in
season
your
is this?
view, a little premature to think that rate cuts are right around the
I believe
corner?
this is
And then
2.
when we do see that first rate cut,
When did he
is
start
that-
rate
should
hiking?
we interpret that as the
Figures it.
beginning of a rate cut cycle, or is it a one-off?
Season 2.
So
I heard season 2 was
I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move
Yeah,
carefully
we were just talking
as
about
we consider when to
how
begin to dial
season
back
2 of
the restrictive stance that we have in
of Powell's
place.
speeches is
So
more serious
If you
than
take that
season
to
1,
the current context,
and the content's
current
just not as
context,
good
we're going to
this
be
time.
data dependent. We're going to be looking at this meeting by meeting. Based on the meeting
Let me know when
today, I would tell you
you
that
cut the rates.
I don't think it's
I mean,
likely
I
that the
think
committee will reach a level
he's
of
not going to
confidence
say
by the
anything
time of the
new
March
here.
meeting
So
to identify March as the time to do that. But
yeah,
that's-
I'll probably
that's
just
to be
end this
seen.
stream anyways.
So I wouldn't call, when you ask
There's
about
really-
in the near term,
There's really nothing
right
happening.
now is March.
He's not really answering questions.
I
He's
don't
already
think
said what he was
that's
going to say.
the most likely case that we would call the base case.
Then your second so
question is,
nothing new.
Well, that was FOMC, everybody. Thank you so much for tuning in, and we will see all of you tomorrow.
The whole thing is
See y'all.
on the data. We're going to be looking at the economic data.
Thanks again